So in the world of stock markets, you can either choose to be a trader or an investor. And while many people use these terms interchangeably, the fact is that trading and investing are two very different things. And to help you understand whether you should choose to be a trader or an investor, we have with us Santosh Navlani, CEO, ET Money. Santosh, good evening. Welcome to the show. To start off this conversation, we really needed to understand what are the qualities of a trader and an investor. How can you identify both of these individuals?
Hi, Kavita. I think for many people, as you mentioned, the words are used interchangeably. But to put things in perspective, trading becomes a very short-term money-making activity from your existing savings. One can put money into a stock or any kind of different investment instrument and actually have a very short-term view. And the short-term view can be as low as a few hours, or it can be as high as few days or few months, but never rarely beyond a year in that sense. So it's very short-term oriented price movement that one is trying to catch and make money from. Whereas investing becomes a very nuanced approach to actually add compounding to your savings in life. You typically don't look at too much price action. You don't really bother about price sensitivity that much. You look at is there an opportunity where a long-term potential can come in for compounding for your money, and the returns over here will basically be kind of higher or lower than trading. That's all up to approach of the investor. But typically, the trading, the window of investment, the horizon of investment, typically will decide how you can be termed as trader or investor.
Now, let's get into more depth and try and understand this. I want to understand what exactly happened during the pandemic. We've got more investors in the market or traders?
I think what happens is sometimes your first exposure can be a trading exposure and you may become an investor. And sometimes your first exposure may be an investor, but you become a trader. What happened in pandemic? I think a lot of investors came in the market because the price was way too low at that point of time, and a lot of blue chip stocks were available at dirt cheap prices with respect to the business potential they were carrying. So a lot of investors came in the market. A huge rally followed, whether it's liquidity or fundamentals or generally time on hand that people always were missing to become a serious investor. So a lot of people became investors. But what happened after that? A lot of trading janta followed, simply because there was a perception or an impression that there's a lot of easy money to be made, and a lot of people becoming riches overnight. And a lot of people has followed. In fact, the number of demat accounts, if you look at a 2 year period, has actually more than doubled. We actually right now have 10 crore demat accounts. And if you think about the entire history of Indian stock market, we were only a 5 crore demat account. So that's a big jump that we saw. And it was because a lot of people made money from investing, because they invested in companies which were actually quite available at low prices. And post that, I think the greed has taken over or took over for some time. And a lot of people actually came into market because somebody made money in a very short period of time, even if he was not expecting to do so. So I think, as I mentioned, it's more about investors came in first and trading followed later, but it can be reversed. I think the market environment will determine how you enter and what you become in the end.
Do you also know of people, or do you come across people on ET Money where they are also investors as well as traders? Can a person be both?
So on ET Money app, actually, we are known and kind of geared towards long-term investments for financial goals. And by definition, we don't serve traders. In fact, we don't have a brokerage account that you can actually open in ET Money. So you technically cannot become a trader. So you can become investors. We offer people opportunities to invest via mutual funds and also via stock and ETFs through our portfolio offerings and the name of ET Money Genius. So one can only invest in ET Money, or invest through ET Money for long-term investments. Trading is not available on ET Money, at least as of now, and we don't intend to be one.
Talking about risk appetite, do you think being a trader involves having a lot of or a high risk appetite than an investor?
I wouldn't necessarily say so, Kavita, because what happens is a trader, by definition, a very short-term window of investment. One is actually to become a successful trader, you need to have stop loss. You need to actually accept both sides of the coin. Sometimes you'll make money in a trade, sometimes lose money in a trade. So risk appetite actually is not a determinant. It's about how much emotional roller coaster ride you can have in terms of controlling your biases, holding on to your opinions, or looking at data. So a methodical approach actually is more determinant of success in trading than actually risk appetite is how I put it.
Okay, now let's talk about the kind of market movements, in the past, and the way you've seen traders going through a lot of loss, and investors, on the other hand, have gained a profit. Is there a history that you can share with us in terms of who's been into deeper losses and who's had like the time in their portfolio?
So that's an interesting thing, Kavita. If you look at the history of stock market, there will always be kind of periods where extreme volatility will come into play, and that has happened in March 2000 time in run up till the 9/11 attacks on World Trade Center. That period was extremely volatile. I think markets corrected upwards of 65% that point of time. It was also repeated in the global financial crisis where markets corrected by 55% odd in 2008. We saw recently COVID, the onset of pandemic where we saw markets correcting almost 40% in India. So what happens is if you are a trader in these kind of market environment, there is a possibility that you lose big and quick in both together. And if you want to avoid that, you might say that let me become an investor. But both are very different objectives. I think trading is more of a almost another side income or a full-time job that you need to have, while investing is more about actually investing for your financial goals. You may be also a long-term investor, full-time investor, but that's not something which you're talking about from retail investor standpoint. We're talking from a standpoint of what does individual investors do. So trading becomes an opportunity where you almost have a business of your own, and hence you would have a kind of an approach towards how much risk you would take, how much money capital you will put into the business, what kind of returns you expect on a monthly or a quarterly basis, or maybe daily basis in that sense. Whereas investing is more about staying put for long term, and these kind of short term volatilities which come in, be it 2008, 2000, or 2020, there are opportunities to actually grab businesses at dirt cheap prices and actually add compounding. So I would say that what volatility does to trading is actually exactly opposite what it does investors. And to traders, they harm and cause loss. To investors, they actually are a opportunity to make money. So it's very different. Both are exactly opposite when it comes to playing with volatility in the marketplace.
So there are a lot of things over here attached with doing trading in the market. People say that it's a full-time job and it's bad to be a trader. You've got to have, you need to get your A game into the market, understanding what kind of stocks you want to buy, when to entry, when to exit. You need those special research and your homework from your side to be done. Are these things really overrated, or this is the fact? If you want to become a trader, you've got to prepare yourself for all this, Santosh?
So I think, Kavita, I will be biased to say that you need a system. You require a methodical approach. You require a plan to be successful at trading. One can be successful by maybe fluke or luck or a gift from marketplace on one or two opportunities. But if you want to make sustained money from short-term trading, which can be intraday trading or trading in options or futures, or for that matter, actually buying stocks for very short-term windows, like a few days to a couple of weeks, you need to know a lot of things. You need to understand technical understanding. You need to know what is the volume in the marketplace. You would possibly need access to data which may not be easily available to retail investors in first place. So trading becomes in my opinion, a full-time job. Is a skill set that you need to have in first place to make money. Whereas investing can actually be done by both ways. You can choose to become a professional investor and actually research well, choose your stocks, do your position sizing, and let the compounding take care of things by staying put for a long time, or give a money to professional fund manager. But trading becomes something you need to not just demonstrate patience and method. Even if you're dependent on some outside party to provide data, you would have your own attitude towards making money, which will be quite a kind of a roller coaster ride, I would say, as any market cycle will keep changing. So you would basically prepare for market cycles which are long term in nature by having short term view towards everything.
Question to you: tax implications when you are a trader and you're an investor.
So I think the tax part, if you look at Kavita, it used to be quite, kind of too much in favor of being an investor earlier, and I would say it has possibly gone away to some extent. So if you look at trading, one would typically have a window of few days or few hours or a couple of months at max. Over there, what happens is if you are kind of trading intraday, which that means you're not taking delivery of shares, it actually becomes more of a other income kind of thing for you, maybe speculative income it can be called, and it is taxed at more of your income tax slab. It is not something which you kind of take advantage of capital gains tax structure. But if you take delivery of shares, that's where short-term gain and long-term gain is classified. The short-term gains are taxed 15%, whether you're an investor or a trader, doesn't matter. But long-term gains are on things when you hold the stock for more than a year. So typically trading by definition may not involve holding a stock for more than a year. Investors would be typically hold a stock for more than a year, and they will be liable to pay 10% of tax on the gains that they make after selling the stock and holding for 1 year. One caveat here is the long-term gains, you actually get tax-free long-term gains every year for 1 lakh rupees. So what happens is your first 1 lakh long-term gains are every year tax-free. So technically you can say that if you only make kind of 2 lakh rupees of capital gains in a year, 1 lakh is tax-free, and you can actually have to pay tax only on the next 1 lakh rupees, which becomes technically 5% on your 2 lakh thing. So long term is 10%, short term is 15%. If you are trading in futures and options, it actually can be clubbed as business income and will be taxed at your income tax slab.
Right. So whether you want to be a trader or an investor, simplified explanation given by Santosh Navlani. Santosh, thank you so much for joining in and explaining this bit to our viewers.
Thank you, Kavita.